The Central Bank of China promotes the yuan as a global funding currency. Global securities regulator warns crypto tokens linked to traditional assets may pose new risks. And Google's to invest 5.5 billion euros in Germany. You're watching Q News. This is the Economic Bulletin, and I'm Henny Saif. We start off with Europe, where European Central Bank policymakers have stated that inflation risks in the Eurozone are now balanced and growth is stronger than expected, supporting market expectations that no further rate cuts are likely soon. ESB board member Frank Elderson and Croatian Central Bank Governor Boris Vujicic both voiced confidence in the outlook amid improving data, suggesting rates would likely remain unchanged in December. Elderson noted that inflation risks are evenly balanced and recent economic news have been relatively good, with several earlier concerns easing. Vujicic added that for now, tariffs have not hurt the European economy as much as feared earlier, but the effects of import front-loading before the duties came into effect continue to unwind. ZEW Economic Research Institute has reported that German investor morale unexpectedly fell in November, reporting a decrease in its economic sentiment index to 38.5 points from 39.3 in October. It added that the assessment of the current economic situation fell to minus 78.7 points from minus 80 the previous month. The Institute president noted that the overall mood is characterized by a fall in confidence in the capacity of Germany's economic policy to tackle the pressing issues. The Office for National Statistics has reported that Britain's labour market cooled noticeably in the third quarter as the unemployment rate jumped and wage growth slowed, bolstering expectations for a Bank of England interest rate cut next month. Data showed that the unemployment rate rose to 5% from 4.8%, the highest reading since the 3 months to February 2021. It added that pay growth, excluding bonuses, slowed slightly to 4.6% in the 3 months to September compared to a year earlier. Moreover, wage growth, excluding bonuses in the private sector, a key metric for the Bank of England, cooled to 4.2% in the 3 months to September. And on to Latin America. Brazil's central bank stated that recent economic developments are unfolding as expected, reinforcing its view that the current 15% benchmark rate is sufficient to bring inflation back to the 3% target. The bank added that the committee will maintain the rate at this level for an extended period, with increased confidence that it will ensure inflation converges to the target. It further stressed that services inflation remains resilient, driven by a still strong labour market, noting that despite a downward trend in inflation expectations, they remain above target across all horizons. Moreover, official data has revealed that Brazil's inflation rate slowed more than anticipated in October, with consumer prices rising just 0.09% compared to September's 0.48% increase. The larger than expected decline has fueled expectations that the central bank could begin cutting interest rates early next year. Annual inflation also accelerated to 4.68% from 5.17% in September, moving closer to the central bank's 3% target. In Africa, the International Monetary Fund has discussed various options with Senegal to address the country's significant debt vulnerabilities. However, the choice of how to tackle the debt, including whether to restructure, is still a sovereign decision for the West African economy. For his part, Senegal Prime Minister Ousmane Sonko noted that fund officials were pushing for a restructuring of Senegal's debt, a move he said the government would not accept, which sent the country's international bonds sharply lower. To China, a European central bank study has argued that weak domestic demand, not U.S. tariffs, is driving China to dump surplus goods in Europe at the expense of local producers. The bank highlighted that rising U.S.-China trade tensions could further divert Chinese exports to Europe, though the trend began earlier when a housing slump curbed domestic demand and investment in China. The ECB added that state-led manufacturing efforts to sustain growth created excess capacity and price wars, pushing firms to seek foreign markets by cutting costs, lowering prices, or accepting smaller profits, even losses, to stay competitive. China's central bank is promoting the yuan as a global funding currency by offering direct loans to foreign companies and financial institutions. The People's Bank of China will provide yuan-denominated loans for bond purchases and trade financing, leveraging China's lower interest rates to make borrowing in yuan more attractive than in US dollars. The initiative comes as the yuan's international use grows. It ranked as the second most used currency in trade finance in September. The move supports China's broader strategy of expanding its currency's global role and reducing dependence on the dollar. Trade negotiator Lin Qingang has stated that China will continue to promote the expansion of market access, particularly in the service sector. He noted that this will bring new investment opportunities to companies, including those from the United States. On another note, the Ministry of Commerce spokesperson stated that China expects the United States to continue working with China to maintain a fair competition environment in the international shipping and shipbuilding markets. Spokesperson highlighted Chinese willingness to communicate and consult with the United States on relevant issues based on the principles of mutual respect and fair consultation. And for more on this, we're joined from London by the research fellow, a Geoshock MSc IR student, LSE, Mr. Alan Tang. Mr. Tang, welcome to the Q News Economic Bulletin. Now, the European Central Bank says it's weak demand inside China, not the US tariffs, that's driving Chinese companies to dump surplus goods in Europe. How much truth is in that statement to the agreement?
So there is a lot of truth to it, but it's not the whole story. The reason behind is that the ECB's own analysis finds export growth concentrated in sectors where domestic demand is weak, notably after China's housing downturn. So excess capacity and weaker home consumption have pushed the firms to seek foreign buyers by cutting price or accepting thinner margins. So that timing predates some of the recent US tariff measure. So the supply side or the domestic demand explanation is empirically important. However, tariffs and geopolitical diversion matters too. So US tariffs and a harder US stance can accelerate rerouting of exports to other markets, including the EU, and make exporters keener to regain volumes abroad. In practice, both force operates and the structural domestic weaknesses created the excess that make price competition possible. So the trade tensions have since reshaped the destination patterns.
Mm-hmm. Well, this Chinese domestic slowdown, how serious is it? Why is it pushing the Chinese manufacturers to sell more aggressively overseas rather than domestically?
So from my viewpoint, so I think the slowdown is materially significant and sector specific, especially where housing, investment, and consumption have cooled, and that weak home demand pushes firms outward. So the evidence shows that the recent statistics and commentary show the cooling retail and investment, and the housing sector has been a persistent drag since 2021 to 2022. So when internal demand is weak, firms with large fixed costs, such for example like steel, autos, and some manufacturing industries, either cut prices and export more or idle the capacity. So that is exactly what the ECB flagged as creating export supply pressure. So the mechanics is like firms facing falling domestic orders cannot quickly shrink capacity. So they preserve cash flow and market share by lowering prices abroad. So offering longer credit or accepting lower profit, which looks like dumping to
Yes.
importing producer. Yeah.
Well, in turn, some European industries say they're being undercut by cheap Chinese imports. Do you think Europe is heading towards a new trade clash, maybe with China?
So I think that the tensions are arising and the risk of an escalatory trade clash is real, but the outcomes really depends on the EU policy choices and the political appetite for confrontation. So there are some signs we can see that it's like the EU has opened multiple anti-dumping or anti-subsidy probes and imposed duties in recent months, such as tires, sweeteners, or some previous EV measures. And industries from steel to chemicals are publicly calling for protection. Reuters and EU trade announcements record a busy slate of investigations and duties. So, however, the EU also balance economic exposure. So, the big member economies such as Germany depend on China for demand and supply chains and prefer calibrated remedies rather than blanket tariffs. So we are likely to see targeted investigations and selective duties rather than an all-out tariff war, unless the political pressures force blunt measures.
Well, it seems that every now and then we keep talking about the de-dollarization, and quite recently we've been speaking about Russia and China choosing the yuan as the trade currency. Now, China is pushing to make the yuan a global funding currency. How does this challenge the dominance of the US dollar?
So from my viewpoint, the Beijing wants more external demand for the RMB yuan to reduce reliance on dollar financing. The lower currency mismatch risks for Chinese borrowers abroad and increase geopolitical and also the financial leverage, but displacing the dollar remain a very long game. So the objective is like the internationalization reduce exchange rate risk for the Chinese firms and also the borrowers, helps China to export the financial service, and gives Beijing more clout in shaping standards and cross-border finance. The recent PBOC moves explicitly encourage offshore yuan financing and cross-border bond issuance to build liquidity and acceptance offshore. So the limits, whereas the US dollars is like the dollar's dominance rests on deep liquid markets and also the safe asset status, the legal predictability, and also the network effects. So the yuan face capital controls, shallower markets, and also the political risk concerns. So the conversion is incremental within the bilateral trade invoicing, bonds, and swap lines rather than an immediate structural replacement of the dollar.
Well, then, with a very attractive yuan with very low interest rates, do you think the world is entering a new phase of trade and currency competition between China, the US, and Europe as well? Do you think it is coming sooner rather than later at a much faster pace?
So I think yes, to an extent. So the cheaper yuan funding can raise China's financial footprint, especially among emerging market borrowers, but it's not a wholesale substitute for dollar financing. So the mechanism is like the lower domestic interest rates and targeted PBOC encouragements make RMB bonds and loans attractive to some sovereigns and corporates, lowering their funding costs and increasing onshore renminbi usage. We have already seen rising yuan bond issuance outside China in 2025 that creates channels of influence, and the lenders and borrowers become more interconnected with Chinese institutions and potentially more sensitive to Chinese policy shifts. So the influence is quite conditional, and the creditors prefer transparency, deep secondary markets, and legal protections. If renminbi assets are less liquid or carry policy risks, uptake will plateau. So expect growing influence in pockets such as regional borrowers, commodity-linked deals, and the bell roll participants rather than instant global dominance.
From London, that was Mr. Alan Tang, the research fellow G-Shock and MSCIR student. Mr. Tang, thank you very much, sir, for your insights. Now we move on to the latest developments from the United States. The U.S. Consumer Financial Protection Bureau has stated that it is legally barred from drawing new funds from the Federal Reserve, but expects its current resources to last at least through the end of 2025. Now, this restriction is based on a legal opinion from the Trump administration, which determined that the Federal Reserve is not currently reporting combined earnings as required under the 2010 law that created the CFPB. As a result, the CFPB cannot legally withdraw cash from the Fed. However, the agency stated it has enough existing funding to continue operating at least through the end of 2025. President Donald Trump has expressed skepticism about 50-year mortgages as a solution by housing affordability, describing the concept as only marginally helpful, despite support from housing officials. Responding to a proposal from Federal Housing Finance Agency Director Bill Pulte, Trump suggested the main benefit would be lower monthly payments spread over a longer period rather than a major solution. The discussion comes as housing remains unaffordable for many Americans, with mortgage rates at 6.19% despite recent declines.
We're in final bids of getting the finest system anywhere in the world. I've analyzed it.
Moreover, President Donald Trump has stated that the United States would face an economic and national security disaster if the Supreme Court ruled against his use of an emergency powers law to impose sweeping tariffs against nearly every country.
Without tariffs, this country would be in such trouble, as they were for many years. That's why we owe $38 trillion. And one of the things we're going to do, we're going to issue a dividend to our middle-income people and lower-income people of about $2,000. And we're going to use the remaining tariffs to lower our debt. We're going to be lowering our debt, which is a national security thing.
President Donald Trump has revealed that the United States is working with Switzerland on a deal to lower the 39% tariff rate it faces on export to the U.S., but said he had not yet settled on a new rate. Moreover, Trump acknowledged that the U.S. had hit Switzerland hard, noting that Washington viewed Switzerland as a good ally and wanted the Alpine country to remain successful. The International Organization of Securities Commissions has cautioned that crypto tokens tied to traditional financial assets may pose new risks for investors as the finance industry remains divided over the benefits of tokenization. It noted that although most tokenization risks are covered by existing rules, the technology itself may bring new vulnerabilities, adding that tokenization could eventually reshape how financial assets are issued, traded, and managed. ISCO further stated that unclear asset structures and third-party issuers could create counterparty risks. It added that despite rising interest, tokenization adoption remains limited, with uneven efficiency gains and little transparency from issuers. Alphabet's Google has announced that it will invest 5.5 billion euros in Germany in the coming years in a push to expand its infrastructure and data center capacity in Europe's largest economy. The plan includes a new data center in Dietzenbach, close to Frankfurt. The sterling snapped a 4-day rising streak as data on Tuesday showed British unemployment rose, while annual wage growth slowed slightly, bolstering expectations for a Bank of England interest rate cut next month. Yields on 2-year gilts, more sensitive to expectations for BOE policy rates, dropped 6 basis points to 3.74%, within a whisker of their lowest since August 2024. The sterling fell 0.33% to $1.3135 after hitting the day before $1.31914, the highest level since October 29th. Global stock markets showed mixed performance on Tuesday's session, with European markets marking the highest gains. In Europe, Germany's DAX rose 0.44%, France's CAC 40 jumped 1.17%, and Britain's FTSE 100 increased 1.09%. Meanwhile, in the United States, the S&P 500 shrank 0.09%. The Nasdaq Composite declined 0.52%, while the Dow Jones Industrial Average hiked 0.51%. In Asia, Japan's Nikkei 225 plunged 0.14%. China's Shanghai Composite was down 0.39%, while Hong Kong's Hang Seng rose 0.18%. Egypt is moving forward with a major green ammonia project through a partnership between Al Nasser Fertilizers and a Chinese international alliance. The facility in Suez will be entirely powered by renewable energy and target annual production of 420,000 tons, primarily for export. The project, developed with China's Envision Energy and Benchmark Power International, supports Egypt's strategy to become a regional green energy hub. Officials said it reflects growing international confidence in Egypt's investment climate and advances the country's transition towards sustainable industry. Saudi Arabia and Kuwait signed 4 memoranda of understanding during a high-level meeting in Riyadh, co-chaired by their foreign ministers. The agreements cover cooperation in media, economic planning, science and technology, and public-private partnerships. The signing took place during the 3rd meeting of the Saudi-Kuwaiti Coordination Council, which aims to strengthen bilateral relations. Kuwait expressed its intention to host the Council's next meeting as both nations emphasize their ongoing commitment to deepening ties. Oil prices rose on Tuesday due to the impact of the latest U.S. sanctions on Russian oil, although oversupply concerns limited gains. Brent crude futures were up 1.1% to $64.73 a barrel. U.S. West Texas Intermediate crude was at $60.78 a barrel, up 1.1%. Gold prices hit a near 3-week high on Tuesday, bolstered by expectations that a potential end to the U.S. government shutdown and a resumption of economic data could set the stage for a Federal Reserve to trim interest rates next month. Spot gold was up 0.3% at $4,127.12 an ounce, having earlier hit its highest since October 23rd. U.S. gold futures for December delivery rose 0.3% to $4,133.2 an ounce. Elsewhere, spot silver gained 0.6% to $50.83 an ounce, its highest level since October 21st. Platinum was steady at $1,578.02, and palladium climbed 0.6% to $1,423.25. That brings us to the end of our economic bulletin, but here's what we've been covering. China's central bank promotes the yuan as a global funding currency. Global securities regulator warns that crypto tokens linked to traditional assets may pose new risks. And Google is to invest €5.5 billion in Germany. These are all the economic and financial news we have for now, but please don't forget to follow Qnews on YouTube, Facebook, X, Instagram and TikTok at Qnews EGY to stay informed. I'm Henny Saif. Thank you for watching.